Do you think life is simpler as time evolves? For some, it can be more complicated when facing issues about health, estate plans, probate, long-term care, and more. That's why Attorney-CPA Joe Cordell hosts ElderTalk with TuckerAllen, providing intelligent answers for those thinking about their future. Here's Attorney-CPA Joe Cordell.
Welcome. Well, it's been another exciting coronavirus week. And not to diminish the seriousness of that, but I think that what we're seeing nationally is a frustration, perhaps a weariness with being locked down. People only have a certain capacity, so much in their tank in which they're willing to live an austere existence. And ultimately, when that's exhausted and appears that that is the case, they come out of seclusion. And they need to compensate for that lost time. So I think that to some extent we're observing that. In the UK, the policy that they launched initially, the policy that was the bold strategy, controversial at the time, that we're going to have relatively minor or minimalist, I should say, rules regarding the extent to which you could be with others, you could gather in crowds, you could assemble, et cetera. And they were spooked from that strategy, but I think that maybe they should have stayed the course. But they had economists at the time who were perhaps part economists, part sociologists. But in any case, they predicted that people only will have a capacity for a certain period of time to live in this self-imposed isolation, and that this won't last for long. So if we decide to start using up that limited supply now, locking them down at a time when the virus is very, very minimal in the country. I don't know how many cases they had at the time, but in probably less than 10,000. So if they exhausted it, then by the time that they really needed this sort of social distancing and this self-quarantining and all these other things, then they just wouldn't have the compliance that you would expect to have. So everybody, and haven't we all seen this? Haven't we seen this sort of total compliance, this enthusiastic sort of team spirit that governed us? You know, it was really strong after the first week. It's almost like 9/11. Remember 9/11? There was this unanimous sense of a joint endeavor.
Very unified.
Democrat, Republicans. It's almost like arm in arm. And it didn't take long for that to dissipate. And I think with this, the argument was over a period of a month or two, when you really, really, really need this thing in place, then you'll have people who will not be complying with the rules. And as that apathy or that indifference or frustration, whatever you want to call it, develops, then, of course, you're in the worst of all worlds, because you have a time when you really need people to be disciplined and they're just exhausted. They're tired of it.
The images we saw at Lake of the Ozarks last weekend for Memorial Day weekend, I think, is a perfect example of that.
Yeah, it's a good example. So there's a dispute between those who, in our country at least, between those who feel we should submit happily to government authority. Government authority is a good thing, and we should support it and cooperate. And then there are others, and some distinguish these between blue and red states. There are others who say, no, government authority by definition it's a necessary evil, and you want as little of it as possible. And we think this is one of those occasions when it's possible to have less and should. So you have Texas strategy, Florida strategy, others we can name, Georgia. And then on the other end of the spectrum, we have Oregon, California,
right,
Washington State. And it really is two different approaches to this coronavirus, and a different to having very different political views. It's interesting from almost a scientific standpoint. And I think many of the virologists are watching this with interest. It's almost like an experiment at this stage, because we don't know. Human beings don't really know the best way to manage this. We only get a chance to challenge it in this way once every 100 years or so in terms of a major pandemic. So I'm watching this with interest too. And Sweden may turn out to be the ultimate model. Sweden.
I know you've said that before.
Well, some criticize Sweden because they have had significantly more deaths than other Scandinavian countries. Norway has had less. Finland has had less. However, you would expect there to be more deaths with the Swedish strategy because it's based upon the idea that you want to achieve herd immunity, which means you have to allow the virus to spread through the population.
Right.
And the whole idea is to control that so that that flow is at such a rate that at no point do you have more people needing, whether it's ventilators, whether it's ICU care, whatever level of medical care, there's no point at which the system is overwhelmed. So at any given point along the way, you're still within that capability of giving the best care. Mm-hmm. You're protecting your older people, the ones who statistically are far more vulnerable. You've told them stay in your homes. I mean, you're comfortable with that given their higher risk. And to
Right.
others, you say go about, in economic productive activity. So Sweden's economy has actually grown some in the past 3 weeks. But they have had more deaths, yet it has been trending downward. I think they had 200 and something deaths just in the last several days. So they keep track on a daily basis, and you can see the trend, and it appears to be a trend that pays off. Texas is doing well right now, as well as Florida in the very latest numbers, just the latest
Right.
week. So that's encouraging. Alabama, not so good. Mm-mm. But we don't know. Look, we're not advocating, and I don't think anybody who's suggesting that there should be more interaction is advocating an indifferent policy.
No.
In other words, just laissez-faire. I don't think everyone knows it's not an intelligent strategy. Instead, those who are for less government and less lockdown and more immunity in that way, what they're really saying is, look, we do need a system in place, but it calls for the least government restriction, and it's imposed on the people who we know are the ones who are at risk. So it is a policy, and it needs to be intelligently pursued. So it is possible, and maybe Alabama is an example of this, it is possible to say we want less government and to be reckless and foolish with that. So I'm not saying I know that about Alabama, but let's face it, everybody picks on Alabama.
Anyway.
Whatever
right.
state has the lowest SAT scores, they're not going to get any respect on any policy. But in any case, so I just wanted to take a couple of minutes and talk about that. I follow it with interest. I know many of you do too, and we're all hoping that we're past this thing soon. So this week we're going to continue talking about what is the impact this virus is going to have on our economy. What do we do as people with money that we figure out what to do with it? And everywhere we look, there appears to be clouds, or at least weather reports in which rain's to come. So we don't know where to place our money. And you listening, those of you, we know you're all over 65. We know that is our core audience. And we recognize that for you, you don't have the luxury that somebody who's 40 years old does. I mean, let's face it, we can make a lot of mistakes. There's a lot of margin for error at that stage because when you make bad investments, eventually they come back. And as happened in 2008, those who experienced more than a 50% depreciation in their portfolio, they saw their portfolio back by, 2013 or sooner. But there's no reason to believe that there's any natural law that requires that. So most people that I'm talking to and that we're doing estate planning for, they continue to have this anxiety about whether they should step into this market at this stage or whether it's premature. And we know that we have an S&P and I guess the Dow now that is 50% back to where it was. The latest Dow numbers are 25,000, and the peak before the fall was 30,000. I mean, it has clawed its way back a good distance, and to some that's a dizzying height, and with a full expectation that it's going to precipitously fall. And others are no, we're on our way back. This V-shaped, much vaunted V-shaped recovery. So we want to have our guest today, who's an authority on this subject, comment, and who we've had in the past, and you guys have told us you really enjoyed, so we've asked him back. Jill, you want to introduce our guest?
Yes, we are so happy to have John Gallia from Gallia Wealth Management back. Yeah, we had you on a pre-pandemic show back in January.
Right.
So, and I understand congratulations are in order?
Yeah, I had a little boy. My wife and I welcomed our second little boy into the world on May 6th.
Congratulations.
What's his name?
His name is Rocco.
Rocco.
Rocco. So
now, is that the full name, a first name?
Well, our first child is Enzo. So Enzo Anthony Gallia, and I'm a junior. So being called John my whole life and having 4 heads turned kind of had me go a different route with my kids. So
yes,
my kids are either going to love me or hate me.
When somebody says their name from front of the class, there won't be any confusion.
Absolutely not. They're going to be the only one. Now, whether they want to continue that legacy or name their kids John or George or Bill, completely up to them.
Now, is Enzo... Is that an Italian name? I know Gallia, your name.
Yeah.
Is.
Enzo is short for a lot of things. Vincenzo, Lorenzo. So we just took the length off of that and we named him Enzo. And a lot of people think of Enzo Ferrari.
Okay,
so,
sure.
Yeah.
I've seen the name.
So
Enzo.
we went with the second child, Rocco Andretti. So we went with a race car theme. I'm not particularly into racing, but I figured if we were going to do it with one child, we might as well kind of make it a theme and
Keep
go with
the
a
theme
second
going.
child.
Right.
So, like I said, my kids might end up hating me for it, but
well, they can change it.
They could do. Yeah, absolutely. You can do anything these days.
And what an unusual time to bring a baby into the world. What's that been like?
It's been challenging. The hard part is when you have a new kid, or let's say you have a brand new grandchild, to not be able to meet them right away, not be able to go to the hospital.
Sure.
You're saying hi and welcoming and seeing them for the first time.
So you were at home during this.
Yeah.
And your wife was in the hospital.
Well, no, they allowed one person to go with you to the hospital. But extended family can't. So a mom, a sister, extended relatives can't come and visit you because they're being extra cautious at hospitals for good reason.
Sure.
But it's tough introducing your child to the world and to family members through a glass door.
Right.
And my mom hasn't held my grandchild yet. And, I'm itching for the day where she can finally do it. But that's the good thing about the government you were talking about right now. We kind of have a choice of how socially distant we want to remain right now. All right. Things are opening back up. We can go to the retail stores again, brick and mortar stores, or if we're in that high risk range or want to be more conservative, by all means, we can do that. And that's acceptable.
And I wanted to ask you, now that the economy is reopening, what have you been hearing from clients? Are they feeling more secure? Is there a sense of calmness?
I think the big question that we have right now is, with all the economic numbers, how can the market be doing so well? All right. So unemployment back in February was at 3.5%. June numbers project about 20% unemployment.
Wow.
That's 40 million people out of a job.
Yeah.
Well, with that and the GDP retracting about 5% in the first quarter, how can the market claw its way back to 25,000? Well, there's a couple reasons. Number one, we have to keep in mind that the market is forward-looking. It's not coincidental, and it doesn't look in the past. So there's a couple things that have happened. The government obviously came out with stimulus package. They might actually have a second stimulus package coming out, which injected about $2 trillion into the economy. Okay, so you have people that are sitting on some money that we look at, since the market is a forward looking index or gauge, we're looking at in the next 12 months or 14 months, there could possibly be a surge. Spending gets back, people go back to being employed, go back to work, that right now that initial fear of how bad could this be has turned into, okay, how long is it going to take to rebound? This isn't the end-all, be-all that we thought it might be. We're done with that knee-jerk reaction.
Sure.
Now, how long is it going to take? And although that's not the question we were hoping to be asking, it's a better question than what we were asking for in mid-March.
And it seems to me that it's far more rational to be investing in the market at this stage than when it was much higher. And it had so much more to fall. And in those early stages, some people were questioning whether we could get through the coronavirus without damaging our portfolios. And at least now the decision's been made, no, there will be an effect. and apparently it's assigned a value of substantially less. But it did come quite a bit up from 50%, where it held briefly. So I can see how some people can look and say, look, I'm not betting on 2020. I'm betting on 2021 and beyond. But I still wonder about these industries that we know are going to be plagued for some time. And the manufacturers that have closed shop or announced they're closing shop. I got just most recently got an email from I read a report about Brooks Brothers where they're apparently closing their U.S. factory, and they're going to, I don't know where they're going to do the rest of their clothes. I don't think they want to admit that they're doing more in China than they've done in the past. So I just think that there have been a lot of changes like that have taken place in a lot of industries. And I just wonder to what extent it's realistic for the market to continue to build from here. Do you think there's some chance of a further fall in the next several months?
Oh, I think there's a lot of chances, and it doesn't have to do with the pandemic either. You know, we have trade talks with China starting back up that we've seen. We have an election year, which is going to be pretty substantial. It could be some volatility in November or October as we get closer to that. But the one thing we want to keep in mind is the devastation on Main Street isn't exactly the devastation that we're necessarily seeing in the markets. A lot of the markets are held by a few small companies. Mm-hmm. Your Apples, your Amazon, your Googles, your Facebooks.
Those who have really benefited from social isolation.
Absolutely. Right. And if you look at exchange-traded funds, ETFs, mutual funds, a lot of their larger holdings are those companies that are pretty resilient to this pandemic that we've seen. So the fact that we haven't seen the major downfall doesn't really surprise me. The fact that we've clawed back, we've seen also some corporate earnings are up for particular companies like Lowe's, Walmart's, Amazon, although the expenses were a bit higher for this last quarter because they had to pay their employees more and they had to spend money on safety precautions for their stores. I think a lot of this has to still remain to be seen. I think there is room for another pullback, especially if there's a second wave. But it wouldn't surprise me if we do have a rebound.
And I know that obviously a lot of experts are betting on that. It's where the market has held firm for weeks now, when many were predicting. Some of the top analysts were saying, look, the market's giddy, investors are not realistic, they'll come to their senses. But when you've been saying they're going to come to their senses for a couple months now, and it's stayed around the same price, then or gone up some, you just have to wonder, maybe there's some commitment to this opinion that the market is going to do better, and in the long run, it's going to all be okay.
Well, and if you look at, too, the stimulus package that the government has put in place, I mean, a lot of households received anywhere from $2,000 to $3,000 extra dollars. And not all those households have had layoffs. So that is extra money that people have received that, like you said, Joe, earlier, they've been cooped up for 2 months, and they're ready to get out, maybe spend a little bit. Subconsciously, maybe they don't want to spend, but they're ready to go on vacation. They're ready to have some fun. So that could stimulate the economy. I mean, that package is doing exactly what it is. It's trying to stimulate. And I think a lot of people are looking a year, 14 months down the road at the indexes and trying to gauge where the economy will be.
And an important factor in this market, there's no question, is the fiscal policy and the Fed policy. I mean, whenever you have a chairman of the Federal Reserve who comes forward and says, as Powell did a week or so ago, that we're prepared to do anything that's necessary to keep this economy going. In other words, apparently he's prepared to write a blank check and to do anything, keep pouring money into the economy as needed. We know we have a fiscal willingness on the part of Democrats and Republicans any disagreements they have are going to be more philosophical, but both parties are behind pouring stimulus into this economy, maybe in a little bit different ways. So, I mean, I think it's hard to, whenever you know that the Federal Reserve, you know, the place that prints money, whenever they announce, we're not going to let you be broke,
right?
Then it's either it's either a point for exultation or to seek citizenship somewhere else. Right. Meaning it in a way it's scary because it may stir up concerns about inflation, and I want to get your thoughts on that. Let me first lay the problem out. I mean, the idea that you can print money at the volume that we have and over a relatively short time period that we have and not cause inflation seems to contradict the things we learned in undergrad. You know, if you took an economics course in undergrad, you're told that inflation by definition means that you're increasing the supply of money.
Sure.
And so what's supposed to happen is the dollar becomes less valuable, which means the effect is prices go up. So whenever we say prices are going up, all that is really saying is that the currency we're using is worth less. So you have to throw in more, like the Weimar Republic after World War I, Germany. We've all heard those stories, wheelbarrows of money. Well, it wasn't that goods were more valuable. It was that the money was worth a lot less. So just common sense tells us, even in the absence of an economics class, that when you throw that much money out there, that it has to at some point start depreciating in value. But yet we do know that the advantage that we have in the U.S. is the dollar is the reserve currency of the world. And most debts around the world are denominated in dollars. Most sovereign debt is in dollars. So that's done because if you lend Venezuela money, you don't want them to be able to repay you in their dollars, right, in their pesos. Instead, you want them to tie it to a currency where they have to really pay you real money, because otherwise they just crank up the printing press and put it in a travel cart and send it to you. But now we know that Venezuela defaults on its debt because it would have to come up with dollars.
Right.
And so we have that around the world. So we do have international demand for the dollar, and we have to remind ourselves that it's not just Americans that soak up the dollar when it's issued. This economy soaking it up. The world is soaking it up, and apparently there's the capability worldwide to absorb a lot of dollars without the dollars losing value. Give me your comments.
Absolutely, we are the big dog on the block when it comes to our currency. You know, as far as inflation goes, we look at 2008, 2009. That was the big question when the government was putting all this money into the economy. All right, what is this going to do for inflation? Well, we really didn't see too many repercussions when that happened 12 years ago. So, obviously we had a big pandemic that caused a lot of people to go out of work. It took a lot of money out of circulation because people aren't going to be spending, people are going to be saving. So they injected this money into the economy, right? So where does that leave us, 10, 12 years from now, 5 years from now? Not really sure. Obviously we've gotten pretty good at printing money, and I think what we needed for our economy to survive was a Band-Aid. And I look at this as being a Band-Aid. Now, the government obviously has ways to get that money back through taxation, through other means, fiscal policy as well. So, longevity, I think they did what they needed to do to stimulate our economy. And I think long-term, we didn't see really the effects of that in 2008, 2009. But long-term wise, they have the capability to, bring the money back into, their reserve.
So this is a quick fix for right now.
I think it's a quick fix. I think it's a necessary fix, but, I don't know how it's going to affect us 5-10 years from now, but it may not necessarily affect us in the way that we think. Because 2008, 2009 doesn't. And the government by far has so many tools and policies they can put into place to recapture that money when the time is right. I didn't know that they could do a stimulus package like they did. It was unheard of. It was unprecedented. It was very creative.
Maybe the Supreme Court didn't know they could do it either.
Right. Exactly. But yeah, that's my thoughts in regards to the inflation. One of the other things that I wanted to bring back to the market is, let's talk about interest rates. All right. Where else are people going to put their money? You can't put them in short-term governments or CDs. Has anybody seen what a CD pays right now?
Yeah.
Next to nothing.
Next to nothing. I mean, it's not even worth the trip to the bank. So you look at your options. You can either sit in cash or you can inject it into equities. And I think that's also helped the markets rebound in the most recently.
So what do you say to those people who may suspect that there's going to eventually be some sort of inflation? So you might have that investor who's saying, well, I want to invest in assets that are likely to benefit from inflation, one of which might be real estate, residential real estate, certainly. Commercial looks scary right now with everybody deciding they don't need an office. So if that person wants to invest, they don't want to go out and buy these properties. Our listeners are people who want just passive investments. So are there ETFs? Are there other options by which, if they're betting that, there's going to be inflation down the road, and among the things that will benefit will be real estate, and even in the absence of inflation, they may say, I think real estate over time is going to benefit. What investments should they consider? What vehicles?
Sure. First and foremost, I will say it's always advantageous to look at your whole portfolio and to see if you can afford taking on, investments like that. Now, obviously, if you've done your research and your grandma's rule, not putting all your eggs in one basket and spreading that out, then there is room for investments like that. Some of these investments will include maybe publicly traded REITs. There are also privately traded REITs or non-public REITs. You're going to get a little bit more risky in those. Those are alternative investments. They are out there, but you really need to talk with a professional and do your research before you invest in products like that. The other thing you can invest in are treasury tips, inflation-related securities that will adjust with inflation if you'd like to take a bit of your money and go that route.
That's an important point. I'm just wanting to pause, be sure people make note of that. I mean, these tips that you're talking about, it's a marvelous tool. And as you mentioned, I guess a while ago, in terms of rates of return right now, of course, it's not good, but neither is anything else. So if you're not as inclined to buy equities, I mean, these tips, what they mean is that they increase what? Is it based on consumer price index?
Yeah, consumer price index.
And so it'll be indexed every quarter, I think. Mm-hmm. So whatever the rate of inflation might be over time, you will get an adjustment for that. So, I mean, if you're one of these people who suspect, and as you might glean from my interest in this topic, I tend to suspect that inflation will gain momentum, then these could end up being a hugely profitable investment, because at a time when others may be earning 4 or 5% in a high inflationary environment, you would be earning far more, depending on whatever the consumer price index is at the time. Now, those can be bought, I assume, they can be bought in denominations below 100,000, I assume.
Yes, yeah. They can be bought in denominations, and I'm going back. I haven't bought any in a while, but I used to be a bond trader when I first started.
So you have insight into this.
Exactly.
Discussion.
So, there's a lot of different investments, mortgage-backed securities that you can look at, tips, treasuries.
Let me get your thought then. What do you think about the bond market as an option now?
It's tough. I would say what's been amazing is, some of these short-term government treasury ETFs that pay typically about a 1.5-2% interest rate are up 5% in a portfolio. Something that's supposed to remain stagnant and safe are up 5% because of the flight to safety recently. So that's amazing to me whenever I look at numbers like that. So it's important if you're retired that you are looking at your allocations, making sure you're allocated correctly.
Good diversification.
You can scatter that into short-term fixed income, long-term fixed income. I think overall, if the fixed income market is to slightly go up in the future, it's going to be because of flight of safety. That people are feeling when the markets, have a dip. Interest rates right now aren't really appealing if you buy individual fixed income.
Do you see, though, that rates may actually go negative in the U.S.?
It's possible. I mean, they are so low right now.
They don't have far to fall.
There could be a negative yield, which is just incredible. Obviously, in a case like that, you'd be subject to either investing in equity or keeping money in cash or investing in real estate or something like that instead of going to, short-term fixed income.
And John, with there being so much uncertainty with this pandemic, we have no idea how long it's going to last. What about folks that are thinking maybe they should downsize, sell that 3,000 square foot house and go to a condo, and so they have a little bit more of a nest egg? What do you say about that?
Sure. Well, right now it's a seller's market. It is an excellent time to sell. Interest rates are low, which drives housing prices up. There is low inventory right now. So if you have a good house and you've kept it up to date, it should be relatively easy to sell. I think it's a good time to sell. It's also a pretty good time to buy. People have been sitting at home for the last 2 months making improvements on their house. So that house you might have been able to buy in February might be a better house now that you're buying it in June. On the flip side, let's say you want to stay where you're at. You have to look at possibly refinancing if you have a mortgage that's above 4.25 or 4.5. Right now, a 15-year mortgage is in the upper 2s, and a 30-year mortgage is in the low 3s. So
that's amazing.
Absolutely,
that's fixed, right?
Fixed. So if you have good credit, now some of the stipulations of refinancing have gotten a little bit more stringent, but assuming that you qualify, I think it's important to look at downsizing, selling, buying, and refinancing if you're within those markets.
Yeah, this is a historic moment. I mean, if you look at the last 100 years, I don't know that there was a time anywhere in that period that you could get a 3-something loan for 30 years fixed. I can't believe there was ever a time in the last 100 years. It's a wonderful rate, and the thing is you're protected so that it suddenly becomes incredibly valuable to you when everything else is 4, 5, 6%. So it is tempting to go out and refinance or buy a new property if you're wanting one.
Sure. I mean, go to the bank and try to get a personal loan. What are they going to charge? It's not 3.25%, So if you're in the housing market, I mean, you got to be pinching yourself that, wow, this is pretty good.
But to your clients, are you having any of them come to you and out of concern because of this uncertainty and asking, should we downsize just in case?
Well, I always think it's a question of, living outside your means. If you are living outside your means, and what I mean by that is what I like with my clients is I try to say every year before retirement, you put 10% into your retirement funds. Okay, you make 10%.
Might be too late for some of our listeners.
It might be some. But in retirement, plan on taking out 4 to 5% per year.
Now, is that still a reliable rule of thumb?
It is. 4 to 5%. I believe, even though we see market dips, you can recover 4 to 5%. What I worry about are the people that are taking out the 8 to 10%. And let's say they took it all out in March. You're not going to give your assets enough time to recover. So, if you're living within the means of taking out, and you're coupling this with Social Security and pensions, 4 to 5% of your money from your retirement account per year, you may not need to downsize if you're staying within that realm. If you're a little bit above that, I think it's always good to try to get back down to only needing 4 to 5%, no matter if the market's high or low or what the economy is doing. I think that's the rule or a thumb rule to safeguard your retirement so you don't outlive your money.
People always fear they're going to do that, though.
Well, if you ask them, what are they afraid of? Dying or outliving your money? Number one answer, outliving your money.
Yeah.
It's the truth.
Yeah. I've got to hurry up and die or I'm going to run out of money.
Exactly.
Yeah.
Well, I can see where people, when they're trying to decide what are they going to do to have a safe portfolio here at the end, many are wanting to avoid going back to work, especially in an environment which, unlike 4 months ago, you can go out and get a gig job or you can get a part-time job. There's so many options to earn money for somebody who's retired. Now I think a lot of those have been soaked up or disappeared, and we don't know when those options are going to come back. And the chance for them to earn the income that they had counted on from their investments is dwindling. It's going down each month. Who was it that went the first time they had lowered their dividends down to 1 cent because they didn't want to eliminate them entirely, so they lowered them to 1. Occidental Petroleum. Mm-hmm. This long history, much vaunted history of paying, generous dividends, and now due to the oil industry, which is affected by the travel industry and other things, they literally are trying to keep the doors open. And they've had to lower their dividend to a symbolic 1 cent. And people bought at one time that stock thinking that would guarantee them solid dividends for the rest of their retirement years. And that's just emblematic of a number of what we would consider blue chip companies that are no longer blue chip. What about the people that bought General Electric thinking, look, among the last companies to go under in America will be General Electric. Yeah. And, Thomas Edison, essentially founds this company, and look at them. I mean, they're selling off everything in order to stay afloat. They dumped many people think GE make consumer products. In fact, they've been selling them off, and whoever they sell them to, and largely a Chinese company, still says GE on it. So when you buy that washing machine and stuff, it's not really made by GE anymore. They sold that in the late 90s. And they sold off most recently their last consumer division. So now there's no consumer interaction. It's B2B exclusively with GE. And that's if they survive.
And the one thing I can say about, if you are an owner of those particular investments, chances are you've had them for a while. Hopefully you're not dependent on the dividend. But if you are, it's a good opportunity to look at diversifying those, possibly selling them. The market has crawled back. There are some industries that I probably wouldn't sell right now. I would wait for a little bit more of a rebound, oil being one of them, because we're pumping gas at $1.69 a gallon. We probably want to wait till we're pumping back at $2.50 before we go and sell our oil stocks. So you might want to wait a little bit for the rebound. But, that's along the lines of diversification, and that's why some of these ETFs, exchange-traded funds, and mutual funds are becoming so popular. You're not invested in one particular company. So if there's a little bit, 2% of your exposure is in an oil company, your mutual fund, your ETF isn't going to see a drastic shift. And, as you get older, it is important to, one, be diversified, but not only that, but look for the opportunity to diversify within income-producing investments. And that's just not fixed income, but that can be blue-chip diversified ETFs.
What do you think we've learned from this pandemic from a financial standpoint, so we can be better prepared if, God forbid, something like this happens again?
Yeah. Well, I think
is there a way to be better prepared?
Yeah, and I remember back to when I came on the show back in early February, one of the things I said is we don't usually get knocked out by the punch we see coming. And a month later, that's exactly what happened. We didn't see this coming, and that's what, really hurt us. Is there a solution to this pandemic? I think what doesn't kill us, only makes us stronger. And I think we've shown how resilient we are. I think we've seen what the government is willing to do to keep our economy afloat, which surprised us. So I think we've learned from it. I think if something like this will come around, we're going to be better prepared. I think people are becoming a little bit more comfortable with the social distancing and maybe how businesses are reacting to it. So I think in the long run, if something like this were to happen again, we will be better prepared.
Yeah, I mean, we've acquired a skill, and the world has acquired a skill.
Yeah.
And this is a skill we didn't possess. But now that we've lived to it, there'll be lots of postmortems. There'll be lots of discussions about what we should have done, shouldn't have done. That'll be analyzed ad nauseum. But the bottom line is we will emerge with a lot stronger capabilities, at least regarding this particular existential threat.
I agree. And I think that, if we were to face this again, it would have to be something that has a higher mortality rate that would affect us than what this COVID-19 has for it to play a major effects. But, once we do rebound from this, and it could be a year, could be 2 years, could be 3, I don't see this being the same problem that we have next, something like this causing a major dip like it did this time.
John, we thank you so much for joining us today and providing us with all this insight. Another question I have is for the pre-retirement folks. With unemployment soaring, there is, those who want to dip into their retirement funds. What do you recommend to those folks?
Well, one of the reasons why we save is so that we have a nest egg for the unforeseeable future. So obviously things happen in life that we can't prepare for. And if we need to or feel like we got to take money from a retirement account, it's there for that. I would venture to say that it's a good idea to only take out the amount you need, not necessarily the amount you want. There could be tax ramifications when you pull money out of retirement accounts or any accounts for that matter. So if you're taking out a substantial amount, I always say it's wise to consult your CPA or your accountant before you do so. But you can definitely do that. Just try to make up for that in the future or be cognizant of the effects of taking out a substantial withdrawal.
Yeah, and of course I don't practice as a CPA anymore, but as I recall, was it $100,000 you could take out up to during this coronavirus period, and that'll expire maybe at the end of July. Mm-hmm. Check with your CPAs. But that was an occasion when you don't avoid taxes on it. You still have to pay the taxes, but you don't have to pay the penalty that would normally accompany whenever you take it out. Well, I was going to get to, John, a couple other issues that I'll probably ask you here in a few minutes off air, actually. But in any case, we enjoy having you. I know that this conversation relates to things that are foremost on people's minds as they think about this. I mean, there's health, number one, and number two, how am I going to be able to afford to live? And these are lots of unknowns now, and it calls for lots of speculation. But the bottom line is, anybody that you all are listening to, they're having to speculate. Now, it doesn't mean that all opinions are equal, but just don't assume that anybody knows for sure what to do at this moment. We just haven't been here before.
Right.
And somebody will be right and people will be wrong, but it doesn't mean necessarily that the person who was right was omniscient.
Yeah.
It might just be blind luck. Mm-hmm. In any case,
right.
We do advocate using financial advisors. I'm a big fan of that. And John Gallia is among the better ones. He's a certified financial planner. So, John, we hope to have you back on the show.
Thanks for having me.
And until next time, this has been another episode of Elder Talk. Take care.
You've been listening to Elder Talk with TuckerAllen, providing intelligent answers for those thinking about their future, with Attorney-CPA Joe Cordell. Sponsored by TuckerAllen, your estate and elder law advisors. For more information, visit TuckerAllen.com. Listen again next Saturday for another edition of Elder Talk with TuckerAllen. The choice of a lawyer is an important decision and should not be based solely on advertisements.